I want to quickly talk to you about venture capital fundraising. And the thing is that if you are actually are a startup, if you are a small business and you are looking for equity or you're looking for funds, okay, not equity, you're looking for equity investment or even business loans, you want to really watch this video from A to Z because in today's conversation, I want to explain to you the venture capital fundraising process, okay? So here are the steps I want you to pay attention to. Number one, you want to ensure readiness for venture capital. The thing is that venture capitalists can be a little aggressive. They are high risk takers. They actually come before private equity, so they come in the initial stages, whereas private equity actually focuses more on established businesses. So because venture capital comes at the early stages of a company, that's why it's called venture. They're venturing their capital. They're actually risking their capital, which means what? Two things. Number one, they pay attention a lot to the business model. They wanted to make sure the business has some traction, right? So the criteria for selection, the selection criteria are already demanding at that stage. Number one. Number two, they demand a higher rate of return. So they might actually give you a little bit of money and ask for 10% or 15% equity. Okay. So they can give you 10 grand. I mean, not 10 grand. They can give you $100,000 and ask for a specific amount of equity. Okay. Because what they're looking for, what venture capitalists are looking for, what VC firms are looking for, they're looking for three things. Once they invest in your company, they're looking for three things. Number one, what they call the monetization, the liquidity events. That's what they call the liquidity events. So three liquidity events. They're looking for an IPO, number one. Number two, a merger. Number three, a share buyback by other investors. Okay. So if you are thinking about actually reaching out to venture capital firms, make sure that you have a minimal viable product. That's important. That goes back to what I said. You got to have a little bit of traction. Okay. So a minimum viable product, often referred to by its initials, MVP. So sometimes you hear the term minimum or minimal. Okay, that's fine. So what an MVP is that you got to have enough features to introduce the product's core value proposition to customers. You got to have a little bit of traction. Okay, the idea behind the MVP is to bring the product to market, test it with early users, allowing them to sample its benefits and provide feedback for later versions. Okay, so that's an important element. So an example of an MVP would be a currency transfer service with 2, 3 transfers available, say US dollars, euro, and Mexican peso. A more extensive range of currencies would be added after the MVP's release. So the first step is you got to be ready for venture capital firms. Number two, you need to get the word out. See, the whole thing is that VC firms are really busy. They probably watch 10 to 15, I mean 5 to 10 to 15 pitch decks every single day. So their calendar is always stacked. Okay, so you got to get the word out about your product. You got to get the word out about your unique selling proposition, and most importantly, the traction that you have seen recently. It can be in the last 3 months, it can be in the last 6 months, it can be in the last 12 months, doesn't matter. So if your company has an MVP that has generated positive feedback, you've hit most or all the targets you set out at the beginning of your journey, such as revenue, customer churn, hiring, etc., and your cash is running short. It's time to begin the fundraising process in earnest, right? And the thing is that when you raise funds, you're not raising for a cheap change. You're not really looking for small amounts. You're going for large amounts, and those large amounts they usually come from VC firms. Okay, so the first step for you is to touch base with those investors that you should have maintained contact with in the first place. So what you want to do here is what? You want to tell them that you are beginning the fundraising process and whether they know anyone in the market, them included, that might be interested. Because if you already have a relationship with some investors, you might as well start with them. And they will almost certainly ask about your sales figures and to see a pitch deck. That's what I spoke about, the pitch deck. And even if they're only casually interested, they would actually, they will actually see the pitch deck. Okay. So the thing about the pitch deck is that it's a summary. I'll speak about that in a few seconds, but it's important because you are introducing your company not only to investors that that you currently know, but to their networks too. Because that pitch deck, once you actually present it to them, they may forward it to their contacts as well. So that's really powerful from a flexibility point of view. So let's talk about developing the pitch deck. Let's talk about what's really important for you. At the end of the day, it's all about flexibility. It's all about credibility, right? So if you think about the venture capital fundraising process, the pitch deck is everything. Of course, you have to still present the pitch deck, but the pitch deck doesn't have to be 1,000 pages. You can have maximum 5 to 10 pages, okay? You want to really make sure that you use graphics a lot, pictures. Because if you have text only, you are going to bore your audience, okay? So now, the first thing to say about pitch decks is that there are hundreds of pitch decks from well-known firms that raised millions of dollars readily available online. Okay, so you can get some inspiration from those already before you even think about hiring a designer or actually using templates. Okay, or even using software. You can really get inspiration already from those pitch decks that have proven some kind of relatability or fundability. The whole idea here is not to reinvent the wheel, but to actually use the wheels that have already been invented. So a quick Google search will lead you to the pitch decks used by firms such as Uber, Airbnb, WeWork, and others. Okay, so whatever the merits of those companies, their pitch decks enable them to achieve funding, and that should be the goal of the startup founder. Remember that you don't need to reinvent the wheel. Again, I want to insist on that. You don't need to reinvent the wheel with a pitch deck. So the medium is not the message. Your focus should be elsewhere. Your focus should be communicating well what your company does and what your company does well, right? Why your company is the one to actually fund this year. If your company addresses a problem better than others, your pitch deck should tell people how. Don't just say things. You have to show how. And showing how is quintessential, especially because, like I told you before, VC firms are having tens of meetings a month. So if you want to really stand out, you have to do something else. So when it comes to the venture capital fundraising process, you need to choose investors. I mean, investors are really important in terms of their credibility, but most importantly, how deep their pockets are, right? So it pays to be somewhat selective when looking at investors instead of using a scattergun approach, actually. So what you want to do here is that you want to look for VC firms that operate in your niche or that have made investments in companies similar to your own. Don't send boilerplate emails, okay? Take time to craft a personalized email to each company whereby you outline briefly why you think your company is a match for their funds. Remember, when a VC firm comes to you, they invest a lot. So that lot that I'm just telling you about is actually worth it for you to spend some time crafting a good email. Okay. So the best ways to find those investors are through sites like TechCrunch, Angel Lists, Crunchbase, and even LinkedIn. Most will ask for a pitch deck after you've made your initial introduction, so make sure it's ready before reaching this stage of the process. Okay. Now, a quick note on sharing the pitch deck. You have to understand, assuming that you speak to several venture capital funds, your pitch deck is likely to evolve quickly from now on. So certain slides will change, others will disappear, and different ones will be added as investors' feedback is taken on board. In short, you are going to be left in no time with several versions of the document and probably several versions of your company's financial model as well. This is where a virtual data room comes into its own, ensuring that your process is organized and well managed. And a good data room will also allow you to keep track of your drafts, okay? And also which investors have seen each version adding considerable value to the process. And that's what you want. You got to have this sort of control, this sort of competitive intelligence, this sort of intelligence throughout the fundraising process. That's important because that's what's going to give you the leverage you need to have to actually get things done at a very scalable level. You have to prepare, and this is an important element. You have to prepare early stage meetings. So if you think about the VC fundraising process, early stage meetings are quintessential. Why? Because first impression matters. First impression matters. Now, the first impression was maybe the LinkedIn cold email you sent out, but there's another impression which comes when the investor sees you in real life, sees how you present, your confidence, your team's confidence, the chemistry in your team, all that kind of stuff. There are actually undescribable things for you to really pay attention to. Okay, so early stage meetings typically run similar to job interviews that most people will be familiar with. You will be asked questions on your background and those of your team. What drove you to found the company that you did? Where you see yourself in 5 years' time? So, one thing you need to understand is that don't be discouraged if those initial meetings are carried out by a VC analyst or associate because the partners, the GPs, are not going to jump on a call unless this is for a big investment. Okay. Usually, the partners don't become involved until a later stage of the process. Okay, I will talk about that later on. Those are the late stage meetings. So, you want to use the opportunity to ask some questions of the venture capital company as well. You want to ask them if there is anything they would change in the deck and where they see the challenges and opportunities. All right. And this is important because you are trying to familiarize yourself with how they work. You're trying to familiarize yourself with their needs and expectations. But most importantly, you want to continually tweak the version that you have so that you can appeal to a larger set of VC firms. One thing I want to say here is that at this stage, if your startup staff structure so allows, it's better to have one person managing the whole pitch deck thing instead of having an entire team. Okay, so you have one person who's accountable, one person who is reliable, and that person will actually own the task. Okay, so that if something were to happen to the pitch deck, something were to be like edited out or changed or whatever, improved, that staff member will be the person to actually talk to. Next, I want to talk to you about late stage meeting. Late stage meetings. So basically, as I was telling you a little earlier, early stage meetings, those are handled by VC analysts, VC associates. Okay, late stage meetings are actually where you start talking to the partners, GPs. I mean, if you're lucky, you can even talk to the GP. If your investment opportunity is large enough, or the VCC's potential in your business. Maybe your business has the possibility to become a unicorn, for instance. Okay, that's really important. That's really important from a flexibility point of view. Okay, but one thing I want to insist on is that those late stage meetings, similar to early stage meetings, are really similar, are really analogous to traditional job interview processes. Okay, so but the only difference is that you'll have more hierarchy coming to those meetings. You have one or all of the partners of the VC firm. There will be more than one meeting, and you can expect to be grilled on every aspect of the company and its competitive environment. This is the main juncture where you can express what your hopes and expectations are. Okay, now be forthright. I want you to be forthright about the areas where you would like help on the technology side or bringing the business to scale, for example. Okay, it's all about actually being truthful, but being assertive. Now, be careful to gauge what the partners are saying, okay, saying to you, and how well you gel with them. Because at the end of the day, we're all humans, and how you actually interact with partners are going to say a lot about your ability to connect. Actually, okay, and also one thing you need to understand here is that those partners are going to become part of your business. So it's extremely important that you are comfortable with them, right? At the end of the day, business is based on chemistry. If there is no chemistry, you're not going to have a long relationships. And when it comes to VC firms, you want to have that long relationships. You want to establish the relationship from the get go because see, VC firms nowadays are also investing in, I would say, established companies. So chances are, if they invest in you early on, that's because they see potential. Of course, it's an investment process. They want to be remunerated, right? Remunerated, compensated. I just say compensated. At the end of the day, if they don't see the potential, they're not going to invest in your firm. Next, let's talk about the term sheets. So, if you are thinking about the VC fundraising process, the term sheet is really critical from a, I would say, from an analytical point of view. If the round of meetings with the partners went well, the next step is to receive a term sheet. As the name implies, the term sheet is a document that outlines the terms of the venture capital firm's investment, their evaluation of your company, the equity stake they are paying for as part of that investment, the finer details of those terms, for example, extra payments contingent on growth, and the rights and responsibilities of both parties to the deal outside of more financing. Okay, so that's it. That's actually the gist of it. Now, this tend to be brief, rarely running to more than 2 or 3 pages. When both sides to the deal have signed, the only thing that remains is to do the post-term sheet due diligence. And let's talk about that. Okay, let's talk about that now. So the post-term term sheet due diligence and closing, given that startups tend to be smaller and less complex than the companies involved in private equity, it follows that the due diligence process is less demanding if you think about it, right? In fact, assuming that you are honest in your dealings with the VC firms, and I want to encourage you to be totally honest, totally transparent. So unless you in fact assuming that you were honest with them in your earlier dealings, this stage should represent little, okay, more than a formality, and is usually wrapped in a couple of weeks. The VC firms brings in the technology expert, lawyers, and accountants to ensure that everything is above board and that closing can begin. So for closing to occur, a couple of things have to happen, okay? The VC firm and your company sign an extended document with more detail than that of the term sheet, essentially rubber stamping the investment and concluding your fundraising process. So this is something to really pay attention to. So overall, if you think about this, despite its reputation as a rebellious industry where technology geeks threw money at good ideas between games of ping pong, the venture capital industry is now a highly structured and even institutional segment of the investment industry. By the way, venture capital firms get their money from high net worth individuals, institutional investors. Okay, you also have family offices and other deep money, like money pocketed sort of players. Okay, the only thing is that basically the demands that startup founders take a suitable approach, actually. Okay, because at the end of the day, you're getting flexibility and scalability. So make a plan of how and when you intend to conduct the fundraising process to maximize your company's chances of raising the capital that it needs. So, in conclusion to this conversation, I spoke to you about venture capital fundraising process. I went through the processes for you. Thank you so much. God bless you. I will see you next time. Until then, remember, stay marvelous.